Hello traders and welcome to the London Forex Broadsheet's daily wrap of the markets for Wednesday, August 6th. The euro declined as oil entered bear market territory during New York trading. There was further bad economic news today from Europe's largest economy ahead of Thursday's ECB rate decision and press conference. Preliminary data from the Ministry of Economics and Technology said that German manufacturing orders fell 2.9% in June. From here, further direction for the euro may be set when ECB President Trichet speaks during a press conference after Thursday's decision on interest rates. The daily chart shows a pair dropping further below the 50 and 100-day moving averages, and looks as though a test of the 200-day simple moving average at the 1.5200 area is on the horizon. Tomorrow morning's interest rate decision and subsequent press conference from the ECB could push the pair closer to that level. The pound continued its decline from the break of channel support on July 29th. There was more bad economic news from the UK after the Nationwide Building Society, which is Britain's second largest mortgage lender, reported that its July index of consumer confidence fell 11 points to 51. This is the most since the survey began in 2004. The fall in confidence was blamed on falling house prices, increased unemployment, and accelerating inflation. The Bank of England is expected to hold rates steady at its Thursday meeting. The 4-hour chart shows the cable testing the support level of the descending triangle as traders now focus on tomorrow morning's interest rate decision from the Bank of England. The Aussie added to its 2.5% decline this week after the Bureau of Statistics reported that rising borrowing costs and tougher lending conditions caused home loans in Australia to slide for the 5th straight month in June. This result will probably put more pressure on RBA Governor Glenn Stevens. The Aussie has been moving lower on a regular basis as traders now speculate that the RBA will lower rates in the near future. The 4-hour chart shows the downward channel the pair is moving in, consistently testing the low of the previous time frame. The loonie continued to rise Wednesday from its break of trendline resistance on July 25th after oil and other commodity prices continued to decline as speculation increased on the rate reduction from the Bank of Canada. On Tuesday, the loonie closed above the high made on January 22nd. A report on building permits will be released on Thursday morning at 0830. The move from the loonie has been quite remarkable for a pair that went nowhere for such a long time. The pair fought through all of the daily simple moving averages and then pushed above the top of the trading range and so far has held. The Swissy rose as equity markets rebounded from the day's lows, reaching its highest level since the May 2nd and May 8th highs. Valuations on the pair are really driven by the S&P, which found resistance on July 2nd and July 23rd at 1294. During its latest run, the S&P has also made a series of higher lows. That trend may have been continued on Tuesday as the S&P bounced well off the daily low. The dollar continues to strengthen against the Swiss franc, and as can be seen on the daily chart is now testing the 200-day simple moving average. The yen traded lower after the Japanese government acknowledged that the economy is deteriorating, and that, quote, there is a high possibility the economy has entered a recession, according to the head of business statistics at the Cabinet Office. Overall exports fell in June for the first time in 55 months. Factory output has fallen for 2 straight quarters and Japan's jobless rate has risen. The government based its assessment of the economy on a coincident index. The dollar continues to strengthen and the dollar-yen continues to trade in an upward channel that has the pair ready to test the 110 level. The upcoming economic calendar has many top-tier releases for us tomorrow. At 7 a.m. we have the official bank rate out of the UK, and then 45 minutes later we have the ECB interest rate statement, as well as a press conference from them at 8:30, and at 10 a.m. we have the pending home sales out of the US. In Asian equities today, the Nikkei rose 263 points or 2.04% to close at 13,178. The Australian S&P ASX index gained 142 points or 2.96% to close at 4963. This is the most in the past 2 weeks. In European markets, stocks rose for a second day. The German DAX gained 42 points or 0.65% to 6561, while the UK's FTSE rose 31 points or 0.58% to close at 5486, and the Dow Jones Stock 600 was up 2 points or 0.93% to close at 287. On Wall Street, markets had been down for much of the session, but managed to close at a 6-week high. At the close of floor trading on the New York Stock Exchange, the Dow was at 11,656, after gaining 40 points or 0.35%. The S&P closed at 1289, up 4 points or 0.34%, while the Nasdaq finished trading at 2378 with a gain of 26 points or 1.21%. Crude oil officially entered a bear market, as today's 1.7% drop meant that more than 20% had been lost since the July 11th peak at 147.27. Crude oil for September delivery closed down 50 cents to $118.58 a barrel after the government report showed an unexpected increase in supplies. Gold futures for December delivery fell $3 or 0.3% to $8.83 an ounce. Gold tends to decline when inflation becomes less of a threat, and since commodities are falling, gold declined for a fourth straight trading session. Treasuries were slightly lower. The 2-year note yield gained 2.4 basis points to 2.568%. The benchmark 10-year note rose 1.9 basis points to yield 4.038%. Overall, the story during Wednesday's New York session continued to be the dollar's inverse correlation to oil prices. But a new factor was added after the FOMC signaled on Tuesday that rates would be staying on hold. With growth decelerations now expected in a number of economies, speculation is rising that central banks from the UK, Canada, Australia, and possibly Europe will enter an easing cycle as the Fed stands pat. Decreases in yields are likely to be seen in government debt outside the US as Treasury yields rise, thereby reducing spreads in favor of the dollar. Sentiment on the dollar is likely to be further improved as the Federal Reserve remains the only central bank whose borrowing costs are negative relative to inflation, and as it continues lending to Wall Street's biggest investment banks and brokerage via its special lending facilities at least through January of 2009.
All contents of the LFB are for informational purposes only and should not be used as a replacement for research by an individual investor, trader, or licensed investment professional. Neither the LFB nor any of its affiliates shall be liable for any errors, omissions, or for any actions taken in response to the information contained herein. We hereby make no representations or warranties regarding the accuracy of any information contained in this broadcast or on our site. Forex market trading involves special risks and may not be suitable for everyone. Each investor or trader should assess their financial situation and risk tolerance before proceeding. Copyright 2007, LFB Services, LLC. All rights reserved.